Would you look at the length of this thing? I don't know. Put down 12,000. That's good enough. They don't need to know that.
Questionnaires are a major impediment in the financial planning process and the main reason clients abandon it. Clients always see questionnaires as an unwanted and unpleasant task. And yet that's how most advisors begin their planning process. Hello, my name is Michael Curtis, and I'm the president of Vision Systems Corp. Thank you for joining me today. We've produced 3 videos. The first video discusses the 6-step financial planning process, which is being used for more than 35 years. We believe that it's antiquated, inefficient, and wastes a great deal of your valuable time.
Let's have a closer look at the most important issues of the antiquated 6-step financial planning process and non-integrated technology. There are a few reasons why questionnaires are a major impediment in the planning process. When questionnaires are placed at the beginning of the process, clients are not motivated to complete them. Clients don't properly complete questionnaires merely because you ask for their financial data. Second, a sufficiently deep relationship may not yet exist. Clients, especially new clients, may not feel comfortable providing you with highly personal information. And third, if planning software is robust, a question must be included for everything the software can model. But lengthy questionnaires immediately create client resistance. The next step in the planning process is usually a conversation with clients about their goals. But when you ask clients about themselves, often they respond with sentiments such as, "I'd like to retire comfortably." It would be unusual if clients identified half a dozen actionable goals. To help clients, you may have developed what we'd call a script. It's a series of questions you ask clients to help stimulate their thoughts. But there's a major problem with this approach. The goals that clients identify are usually limited to the questions you ask them. If a question isn't asked, an important want could be neglected. And there's one more major issue. You likely limit the number of questions you ask clients because of your planning software's capabilities. For example, most software can't properly model vehicle purchases, so they're lumped in with general lifestyle spending. And yet, vehicles are a major expense over the course of your clients' lives. Besides, it's unlikely that 2 vehicle families will still be driving both vehicles late in life. Finally, responding to a series of questions is not emotionally engaging. It's boring and tedious. In short, no effective technology is used when helping clients identify their goals. There's another important issue related to a goals conversation. A plan needs 2 points: the starting point and the end point. The starting point is the client's current financial circumstances, the types and value of assets they own, any liabilities, their sources of income, and their expenses. The end point is their goals. When working with couples, though, there's a major dilemma. Couples don't 100% agree on their goals all the time. And even if they do agree, they may not agree on when something should be done or how much it should cost. How you manage disagreements can undermine the entire planning process. It's that important. To manage disagreements and different points of view, advisors often try to reconcile them. You might say, "Why do you feel that way?" You have to do this because when you create plans for clients, you need to know the end point. But reconciling different points of view takes time, often leads to negative emotions, and almost always results in a winner and a loser who may, at least emotionally, subtly drop out of the planning process, thereby undermining it. Ultimately, planning is about learning and decision-making. In the six-step process, advisors create plans for clients and present plans to them. We need to go back in time to understand why this became the standard. In the early planning era, because technology was very crude, advisors used tools such as spreadsheets, tax software, and word processors. Because a variety of tools were used, advisors had to create plans for clients and then assemble their recommendations into an attractive written format they could present to clients. But creating plans for clients has four major disadvantages that may result in plans that fail to meet clients' expectations and that, for certain, will take up a great deal of your valuable time. Let's look at them now. When you create plans for clients, the underlying assumption is that great plans are also technically the best. They take maximum advantage of tax savings tactics and more. But that's not true at all if clients fail to fully implement the plans you create for them. The best plans are those that help clients achieve their wants in life and that suit their personal preferences, their values and financial attitudes, their money behavior. Clients must feel comfortable with their plans so that implementation follows naturally. When you create plans for clients, they have to necessarily focus on financial planning strategies such as tax, portfolio, and insurance tactics. These are your areas of expertise, but financial planning tactics are outside of clients' direct control. When achieving goals is based on uncontrollable tactics, clients' confidence in their plan is undermined. When you create plans for clients and present plans to them, the written plan becomes the learning medium. It acts as a proof statement for your recommendations. That is, it explains those recommendations and displays the before financial forecast and the after consequences of implementing them. Written plans prove to clients why your recommendations are worthwhile. But creating lengthy written plans takes a great deal of your time. And more importantly, written plans are not an effective learning medium. Learning and decision-making that leads to action is the point of the planning process. So why use a learning medium that's not effective? Another disadvantage of creating plans for clients and presenting them to clients is the meet and revise cycle. When clients see their financial forecast, they get a glimpse of their financial future for the first time. With this new perspective, they often ask for lifestyle revisions. For example, if the financial forecast displays a surplus, they might want to know how much more they can spend on vacations. You make notes about the changes clients want to make, adjourn the meeting, make those changes, reprint the output, and meet again to review the new financial forecast, which in turn can lead to requests for more changes. This meet and revise cycle can take up a lot of your valuable time. Finally, let's talk about plan reviews. An annual review takes almost as much time to put together as the original plan. That's why reviews are conducted annually. But the true purpose of planning is to help clients master change. When clients are considering important changes, you should proactively enter those changes into your planning software. Clients will see their long-term impact of the changes and then make the most informed decisions possible. The purpose of planning is to master change. We all have to manage it. The only way to master change is to use realistic planning software that acts as a practice field for real life. VisionWorks enables you to help clients test their options and assumptions so that they can see the long-term impact and thereby make the most informed decisions possible. In the next video, we'll demonstrate how the life planning process overcomes the issues that are inherent in the antiquated six-step process. Please visit visionsystemscorp.com to book a demo. Thank you for your time.